With insurtechs, a lot of them that are still in growth mode, they do operate at a loss, just like any startup is more likely going to do. But that's an area where I think you find a lot of insurtechs face criticism. That and just their rapid growth. So, I have to be honest, I've been on the other side, and from the outside, if you look at a lot of the startups out there, you look at their loss ratio and put it on a like-for-like basis, or you look at their valuations on a price-to-book multiple or things along those lines, insurtechs are trading at higher multiples. Insurtechs are operating with higher loss, expense, and combined ratios. But the other thing they are doing is, with growing fast, is also learning fast and catching up. So first of all, reinsurance is really insurance for insurance companies. Of what reinsurance is, or that insurance companies actually buy insurance themselves, but they do. And there's a number of reasons why an insurer would do such a thing. But I tend to think about for a number of reasons. One would be protection from severe events. So if you think about it, if you are very concentrated or exposed in a certain area, you might want to buy reinsurance from someone who's a global reinsurer that can spread their risk out. But there's numerous others where reinsurers are effectively a form of capital as well that's very nimble. So a lot of the reinsurers are really huge in the insurtech space because they support these insurtech fast-growing companies with their capacity as they grow. And with reinsurance, they can be side by side with you, or they can protect you from volatile events. And that's something we have. We have both here at Root. So Root it's known for being, I believe, the first mobile-first digital insurance carrier. The whole fact that we're a full-stack carrier and we own the operations, but we also have our own in-house telematics where all the technology is built in-house, and we're not partnering with any third-party providers for the analysis, the capture, or any of that relating to the telematics data. We own all of it. We build the models all on it. And in our pricing, because everybody that we write is using telematics, we can make our rating models include telematics from the ground up, as opposed to at the very end of a calculation over the top. Last year, we did announce the pledge to remove credit score from our rating by 2025. Now, it's not something we've done right away, and it would cause a lot of disruption if we did, just because credit is currently embedded in our rating models. But, it made us kind of stop and think about things a bit, and there's a number of reasons why someone would not want to use credit or somebody would, but maybe it would help to give you a little bit of the history of kind of why credit score is used to begin with. And we found our sweet spot to be seed stage companies because they're early enough that the things that we can offer, whether it be actuarial, underwriting, claims, finance, various support on the insurance side, we can accelerate these companies and even provide them with reinsurance capacity. So a lot of the companies we supported when I was at Greenlight Re were MGAs, and we supported them at early stage. We led a lot of those rounds. Yeah, as technical as a VC may be, or as technical as a reinsurer is that might be focused on the numbers, the economics, etc. At the end of the day, so much of it comes down to the relationship and if somebody's a right fit for the relationship. So not everything is going to be easy and smooth and going well. And if you have a relationship, it's a lot easier to go through that with somebody if difficult times, and coming out of those difficult times with a successful result if you have that relationship.